Good morning. It's Ways and Means, February 25th, Wednesday. Today we are going to take some more testimony on corporate link up. We have a lot more information available than we did last time that Pat and Kirby will take us through, as well as proposal and making to the committee. And then we have testimony at 10:45 on H886 from two national experts. And then after lunch, we're doing a first walkthrough of a bill from the General and Housing Committee that we're going to need to spend a great deal of time on over the next 2 weeks. And then we're going to take up H750 and 215. And I think we have a couple bills on the floor today. Representative Maslin and Wozniak. Okay, fully out. With that, it says Kirby then Pat on the agenda, but we're going Pat then Kirby. Fun times. Really mixing it up, team. It's so zany. It's all zany.
We're fine.
Oh, maybe I took yours here.
No, my bill.
Oh. Good morning, committee. I am Patrick Titterton with the Joint Fiscal Office.
Oh, well, you represent.
There should be a document under my name on the committee's website, but I'm also going to share on the screen. Okay, so what I'm going to talk about today is, as the chair mentioned, we've had a chance to review the estimates that you all saw back in January about things that are flowing through. Things have changed. And I want to sort of maybe contextualize the numbers that we'll be looking at, so you can understand sort of some of the decision points you're going to have coming up. And then, yeah, from there, I'll remind you what some of those provisions are doing. We'll look at some numbers associated with the language that Kirby's got. I'll let him go into a little more detail, but I'll list out what those things are. So when thinking about HR1, remember there was a lot of discussion about whether something is above the line or below the line, because Vermont does couple up to federal definition of.
I'm just going to interrupt for 1 second. I know we've gone through this before, folks, but this is actually like new news that we're about to get. So, yeah.
Yeah. So remember all that with the stuff that flows through, what stuff that doesn't flow through. We don't always have great visibility into things that are done on the federal form, but ultimately end up as our starting point in Vermont. So that's an area where we've gotten a little bit more information. But here I've listed, and we'll go through all these again. I've listed out all of the things in the business corporate world they're expected to flow through, and then the one provision for personal income taxes. So I just want to sort of let you know why we're updating these numbers. Back in January, like I said, we had very limited information. A lot of that federal data is very difficult to get. We have been working together with the tax department to roll these new numbers out. And it's really 3 elements as to why we felt it appropriate to update these numbers. We have additional information, including federal updates on receipts. We've been monitoring other states and what their revenues pictures are looking like as HR1 has started to flow through the system. We also looked back at a few of the estimates and updated some of the methodology to using some assumptions we think are more appropriate. And so we'll dwell on this table for a few minutes. This is all the same provisions that we saw prior. And I guess it does require some context as to how do you think about what these numbers are showing. So under current law, we've talked a lot about conformity and how that works. We're static, but we update traditionally every year to move that tax date forward. Currently, our static date is pre-HR1. So really, the decision whether to link up or not is an active decision that you as legislators will need to make. And what this table is showing here is if you just move up the conformity date so that you're pulling in all those provisions for HR1, this is what the revenue impact would be. this is not this, so this would be not accounted for in the forecast because those are based on current law. And, I think that your colleagues over in the Appropriations Committee will be very interested to see what you decide to do because, if this all flows through, we're estimating that that's $21 million here that you would need to account for in the budget.
That $18.9 million loss in domestic R&E is a big change from our previous discussions. Talk about why is that? I know you said updated information from other places, but that's a shocking number.
Yeah, so there's a couple of things going on. We did try to use the state's credit as sort of a proxy to get at some of the behavioral change. What the problem sort of ended up being was that there was a scale of magnitude. So we were maybe appropriately capturing behavioral change, but at the same time, not capturing just how much or how significant this deduction is. What we've seen in a lot of states really is that those who are not conformed or static to previous years and are therefore not pulling HR1, they're actually kind of seeing not much of a big change in their corporate income tax revenues. But of the states that are conformed, they're seeing larger decreases than they maybe were expecting otherwise. And so some of that information as well is leading us to believe that this is more significant than we'd initially anticipated.
I don't know if folks remember like the last quarter of last year, there was a big drop in corporate revenues and we weren't sure what it was attributable to.
Yeah, and that exact thing is something we've seen happen in other states, particularly the ones that are conformed. So
You're saying last quarter of right.
yeah.
Can you talk more about our colleagues in appropriations and like what you said about there being a $21 million loss for this and sort of how, yeah.
So basically the basis for the budget kind of ties back to the consensus forecast, right? Tom and Jeff go through, create the consensus forecast. Those figures are sort of the basis point for developing the budget and making sure that the dollars you're spending fit within what the consensus revenue is forecasting we're actually going to bring in. So you need the money coming in for it to go out. So really what that means, and I mentioned this, that the forecast is done based on current law, which for conformity usually doesn't really matter. It's not a huge deal in most years. This year, the active decision to link up will create a revenue loss, which is not accounted for in the consensus forecast, and therefore needs to be considered by the Appropriations Committee in building the budget.
And one sort of piece that we are going to need to grapple with and that the tax department will come in on is the governor's budget, proposed budget was based on not this loss. The governor's budget did not account for this loss of $21 million of revenue, but the tax department has but the governor's policy proposal has been working towards conformity. Because they were working with the same numbers that we were at the beginning of the session of it just being like, $1 million matters, but is also, a very different conversation. So I think, we're going to have tax in once they're they've come to terms with this and they're ready to come in on it.
Sure. Could you give us a primer on when HR1 actually takes effect? And aren't we going to more as of the April deadline as well? It's affecting states and Vermont?
Yeah, so HR1 was applicable to tax year 25. So that's stuff that's coming through this April, right? And so, yes, we will know more, definitely. But I think more so the comment or message I'm trying to convey is if you do, let's say, just link up, this revenue loss is not accounted for in the budget process. So yes, we will know more. The more time that goes by, the better information we get. I mean, you can already see based on what I first shared with you all to today, we've already, gotten a lot more information, a lot better information. But yes, it's true. The more time we have, the better information we get as things roll in, and those filing deadlines will, of course, be very valuable.
Sam Brannigan?
Patrick, do you, so that 21 mil goes somewhere. It goes back out into the economy and circulates around in the business world, and some of it is invested. Maybe most of it is invested, I don't know. Does anyone know? And can we estimate the value of those changes, if there is any, in that circulation of the 21 million?
So there's a couple of different things, I guess, that can be said about that. One thing that I would remind the committee of is the single sales factor apportionment. So for a lot of these corporate related taxes we have here, the parent company, the unitary filing group, yes, they'll be saving some money on their taxes, but they could be located in Texas or Delaware, so it's where is the money going back into the economy and circulating? It could be somewhat in Vermont, especially if they're Vermont based. But it could not necessarily stay within Vermont. But yeah, I mean, when corporations have higher profits, there's several different things they can do: dividends, stock buybacks, capital investment, research and development type stuff. So the money doesn't just stay in their pockets, I guess I think we're agreeing maybe. But I would remember the single sales factor apportionment piece of it.
Okay, good. I had not remembered that, so.
In your previous testimony, you had talked about, there's a joint council on taxation that tries to estimate what revenues, what committee?
I think it's joint. Yeah, JCT.
Okay.
JCT.
Okay, about what the potential impact would be in terms of revenue growth from some of these tax activities. And I think there was estimates in there about what behaviors might be.
Yeah, when we were looking at some of the estimates, it became kind of evident to us that they were using some kind of underlying growth metric. It wasn't necessarily spelled out what they were doing exactly in their methodology section of the report. But there are some assumptions, and their estimates go out over a much longer time period. I think it's maybe 10 years. So, in a 1 or 2 year snapshot, I don't know if you necessarily see that as starkly as you would over a broader time horizon, but there is some accounting for that and what they've done, yes.
And so I guess to say sort of like long story short, from my end, this is a very different conversation than it was before. And I believe the tax department's gonna be treating it that way as well. So just wanted to.
The tax department have been very valuable partners in a lot of these updates.
Okay.
Before it was like, it's $3 million, why change everything? $21 million changes the perspective.
And $34 million
Yeah.
in a year that we're expecting. Slowing of revenue is a huge deal too, yeah.
So if I understand it, if we were to decouple from HR1, how much money would we actually be able to bring?
Such a great question. Should we go to the next slide?
Oh, okay.
That's not quite the next slide. I can just quickly, so there's kind of two parts to that question. There's decoupling from HR1, which would essentially mean we're treating or acting like it never happened and not conforming, not moving forward. If we were to do that, essentially all these numbers would become zero because we're just sticking with previous law. decoupling from the sections in US code entirely, in many cases, would actually have revenue increases to the state, which we will see in a look at.
One of the pieces, there are administrative concerns with just attaching ourselves to a date certain rather than sort of decoupling and creating new definitions. And we heard testimony about maybe how California had done that and how like confusing it was for them to catch up from it a bunch of years later. And when we did this previously with personal income, we didn't do a date certain. We sort of revised some of our definitions and in order to have sort of our tax policy be more consistent internally. So
Sorry if I'm a little bit slow this morning. Can you just say a few words about the assumptions behind the 18.9 million? How did that arise? So those are all assumptions based on folks that are paying taxes in Vermont right now? Or I'm just trying to understand the balance between assumptions that are Vermont specific and assumptions that are based on other states and how those come together to get to that 18.9.
So there's a few different parts. What part of it is we're actually, we've been keeping our eyes on what other states are reporting in terms of their monthly collections. We've been looking at some of their estimates that other states have been doing, and with particular interest for those who are rolling conformity for corporate income taxes, meaning that they don't have to do anything to link up. It's just automatically, it's an automatic trigger. But and also I think that some of our assumptions around the magnitude were a little bit too conservative back at the time. And part of that is informed by what we're seeing in other states. And also the federal government has been publishing some information on receipts. And we do, each quarter get a little bit more information. It's sort of incremental, but each quarter, because that's the basis that a lot of corporations do their estimated taxes on, which is a reflection of their anticipation of tax liability. So there's a few different things sort of informing our decision to up it. And I think that, it's a little bit more consistent with, what we're seeing in our revenue data in the corporate world, and also what we're seeing happening in other states, particularly those that are rolling in corporate. That kind of.
Yeah, I guess I'm still just, yeah.
And I guess one methodology change that we did explore a little bit was how we're scaling. Because scaling is always not the best. It's not what we prefer to do. And in this case, when we shifted to a scaling approach rather than, looking at some Vermont specific data, that also is something that contributed to the number increase quite a bit. So scaling is not always our preferred, but the Vermont specific information we had at the time was, we think, maybe not as appropriate as it could have been.
Just to be clear, so scaling means you're looking at the total potential impact across the country and then scaling back to what Vermont's percentage may be based on that.
Yeah. Not our preferred method in most cases.
So you talked about rolling conformity with other states, but we must be doing the same thing too, right? I mean, our state is conformed. Last quarter is conforming to HR1, correct?
No, so in statute right now, and Kirby might be able to talk on the specifics a little bit more, but in statute right now, we are linked up to a date that is prior to HR1. So we are linked up to federal definitions and codes that reflect pre-HR1 treatment of all these different provisions. But I mean, the other thing also is that, so Vermont is technically a static state, which means that every year when you conform and link up to federal tax law, it's an active decision that you're making. How it usually ends up working out is that Vermont links up each year. So it's almost kind of like we're on a rolling basis, but you are actively doing it each year through legislation. It's typically in the miscellaneous tax bill. the link up language. The last year, there wasn't one. I think it maybe ended up in the budget, that language.
Yes.
Yes, okay.
Yes.
But it is, so in current law, current statute, we are linked up to a date prior to HR.
And when we as a legislature do our, whatever we're gonna do, what date does that go into effect?
Sorry, may I ask Kirby a question?
Yeah, of course. And I also, we're gonna hear from Kirby after Pat, but yeah. Kirby, do you wanna speak to it all a little bit?
Sure, Kirby Keaton, Legislative Council. So that link up, so last year's link up was to 2024. And so that's where we are right now, as far as what the current state of Vermont law is. It's linked up to the federal code as of 2024. HR 1 passed in the summer of 2025, so it's not part of our link up right now. It was part of the budget last year. The budget became effective July 1st. Well, that's typical. So that's when we would have linked up. We would have linked up to 2024 on July 1st. So now that's where we are. And so the link, if we did a link up this year, I'll go into this later, but you can selectively decouple, but then link up to the whole thing both, right? So if you link up this year for all the things you don't decouple from, then it would be 2025.
Thank you, and I guess, the reason I'm bringing it up is I just wanted to have some idea as to where corporations stand with their decision making. I mean, I don't want to have them assuming and planning for something and then us throw a wrench in the works quarter through the process. So,
I think it's a particularly confusing thing that doesn't come up all that often. So, because we have static conformity, but we have a pattern of conforming every year. I think some corporations assume we'll just do that every year, but we do need to pass statute on it every year. And there certainly are years where we haven't, or we had very stern conversations with the tax department about how they need to be careful about how they're communicating about it. Maybe 4 years ago, we had a stern conversation. And given that, and there was a really good article in the New York Times about how sort of nonpartisan the decoupling and coupling seems to be around the country right now as each state grapples with this. And I think NCSL had an article about it as well. But because of sort of the way that the federal bill passed, I think corporations are on uncertain footing in every single state right now. Because states that have had rolling conformity are decoupling, which is sort of a bigger deal than us who do actually make the decision every year.
thank you.
Yeah. It's super uncomfortable though.
Shall we go onward? So next sections, if you are interested. These are all slides you've seen before, but it's just to sort of remind you or refresh you on what each of these provisions is actually doing, the ones that are flowing through. So the big one, the one with the largest increase, the domestic research and experimental expenses. What HR 1 does was change how corporations calculate what their deduction amount is. And so just as quick history, starting in 2022, CJA, these expenses were required to be amortized over 5 years, which meant that the benefit from the deduction was realized incrementally over that 5-year period. Prior to TCJA, and that starting in 2022, should say 2018. So prior to TCJA, incurred R&E expenses could be deducted immediately. So didn't have to spread it out over 5 years. Way the HR 1 is doing is it's going back to prior TCJA treatment. So you can deduct all of these expenses from your net income right away. And so in effect, what this does, and it's also retroactively allowing you to deduct expenses going back to 2022. So what in effect that's doing is it's piling a whole bunch of R&E expenses. It's front loading it. It's So over time, sort of in the longer view, we would expect this number, sort of the lost revenue to, or decrease in revenue to decrease over time. Because you're really front loading a lot of those expenses when you're allowing them to take it right away. And so, yeah, if you all decide to link this provision up, this is something that will flow through, as you saw here at the table, and have a sort of large early year impact for the state.
Representative?
So if I think I got what you said, and so if I look at the slide before then, right now, it's a big revenue loss. And then in 27, it's a big revenue loss. Won't that start going down?
If we had maybe even 3 more years, you would start seeing in 28, it would start decreasing over time. So it's really those first 2 years where a lot of those costs, we would expect to
All of
be
a sudden
front
you
loaded.
say, oh, front load this year, and then I can't take a deduction now for 4 more years. I would think it would go down a lot faster.
Well, if
Oh,
if you have more, if you keep spending money on research and research and development, then yes, it's kind of how it works now, in the sense of you have these expenses in 2022 on R&D, you've been amortizing that over 5 years. But let's say, so in 2022, you also had some in 2023, that's another 5 years you spread out before. So every year when you have these expenses, you can't take them.
no. Does the tax department know which corporations are taking advantage of this and kind of growing their companies in Vermont? I mean, this is a big help for Vermont companies.
We don't have great visibility. I actually have inquired, and it seems to not really be available. The federal forms that are attached to the state forms that we get here. So there's not very much visibility in terms of what companies or what type of companies are doing it. But I will also, again, kind of coming back to the single sales factor apportionment, remind everyone that this doesn't have to be R&E expenses in Vermont.
Just, yeah.
The activity could be happening anywhere else, really.
Do we have any, and we don't know that either.
No, but we did ask the chamber that very explicit question, and they also had no idea.
All right, because I'm.
But the majority, like,
Competitiveness, and I'm concerned about that.
so
I
let's,
wonder if there's any way. we
I think
can
more will come. It'll be exciting.
That's happy, exciting.
I think so. I think you'll like it. I don't know.
So yeah, we're gonna go through just reviewing or refreshing on what was in HR1, and then I'll also talk about some of the other provisions which might speak to your interests. So there's the amended limitation on business interest deduction. HR1 expanded that limit of which corporations can deduct interest paid on loans for business purposes. There are 3 sort of limitations that cap how much of this you can take. But what HR1 did was it increased the percent or the portion of the business interest that you can deduct from 30 to 50%. So previously that interest that you were paying, you could deduct 30% of it. Now you can deduct 50. Again, Vermont's coupled to this provision, so if we link up, that will flow through. There was a limitation on expensing for depreciable business assets. This is specifically geared towards small businesses. So it increases the maximum amount that a taxpayer may expense the cost of a qualified depreciable asset in lieu of recovering those costs through depreciation. In many instances, I think the depreciation window is usually like 39 years for something like a building, factories, other types of durable assets. And so previous to HR1, these businesses could just take, they could expense $1 million of that rather than depreciating it over a long window right away. What HR1 is it expands that from 1 million that you can expense to 2.5. Again, this is an area where we are coupled, or so linking up would cause it to go through. And I guess actually, so Rebecca, Deputy Commissioner Samra, was in here a few weeks ago. We had a table with some of their thoughts on coupling it and decoupling. If you remember from their table, this provision, the business interest deduction, and this provision, the depreciable business assets, they had highlighted as red as very difficult for them to administer if we were to decouple. But that's not.
What do you mean, Darren? I'm just letting the chair know I have a question.
Okay.
But that's not the case for the special depreciation for qualified production property. This is in a sense like a bonus depreciation. And that is something that Vermont is already decoupled from. So that was one where they had I think it was a red box around it or green box around it actually, saying that that was something the department was asking for consistency purposes because we already add back bonus depreciation to decouple from. And so what this one is specifically is it allows a deduction for qualified production property of 100% of its cost adjusted basis. So you can basically claim all the depreciation right up front for qualified production property. Has to be used for qualified non-residential, or has to be qualified non-residential property used in manufacturing or production of tangible personal products. And it's further limited to agriculture, refining, and chemical production. And it does have a specific time window. So the change applies to properties built or bought after January 19th of 2025 and before January 1st of 2029. So yeah, this is another one where you need to make a active decision whether to decouple or not.
Representative Meslin on the Muzzle.
Yeah, a couple slides back. Floor plan financial interest.
Okay, so I didn't know, this is one, it seems to be specific to car dealerships.
Oh, okay.
Because they will typically get their inventory on credit from the manufacturer. And it kind of makes sense now why they're always pushing so hard to get cars off the lot. Because the longer they're sitting there, the longer that they're incurring interest that the dealership hopefully has to pay back.
Thank you.
I learn things sometimes when looking through this stuff.
So do we.
I listened to a really good podcast about the business model of car dealerships and how they share. Just Representative Lonsack. I'm sure we're gonna, yes, you as well.
More of a curiosity, January 19th. What happened on the 8th?
I don't know.
Buddy. I was still in on the 19th.
Sure.
In America.
And so for the foreign derived intangible income and global intangible low taxed income, FDII or guilty. So HR one increased the bases for both of these. And these, there's essentially foreign derived intangible, or it's foreign derived income. And so HR one's kind of changing how it's calculated and also changing what the deduction amount is for this. So I'm going to try and be simple because I think we've said in the past, if you want a full breakdown of these provisions, we could spend an entire afternoon together. But basically what was done is that the federal government has, through HR one, changed the base. Right, so they've increased the base of these provisions and at the same time, increase the deductible amount for these provisions. So on one end, it's increasing, on the other end, it's decreasing. There's the changes to pro rata share rules. So HR one changes the treatment of controlled foreign corporations or CFCs. If a foreign corporation, just as definite, it is a CFC if at least 50% of the voting power or value of the stock are held by US shareholders. And so what this does is each US shareholder must include in their gross income their pro rata share of the CFC's passive income in that tax year. Taxpayers that hold stock in CFCs will have to report more gross income than they would have previously, is essentially what this works out to. Again, we're coupled here, so linking up would cause this to flow through. This might be the last one. Or there's two more. So charitable deductions for corporations.
Representative, what did you do?
I was gonna say, can you give an example? I almost am surprised to see this.
On charitable deductions or the slide before it?
Changes to pro rata share, sorry, that's why. We did that one.
Yeah, but we can come back to it.
So a foreign corporation as a CFC, if at least 50% of the voting power are held by US shareholders. So it seems like they're trying to make the US shareholders in a CFC pay more income tax. It's interesting that the federal government want to do that. Yes.
I can't speak to their intentions.
Representative Rennigan?
And so I'm thinking about that same thing, Carol, and I wonder, Patrick, you know, the only example I can think of is maple sugar manufacturing equipment created in Quebec, brought over across the border to Vermont, and there are little dealerships here that sell the equipment. So is that the kind of business we're talking about? The guys that own the dealership have to absorb some of the wealth that's created in Quebec? Is that?
I would encourage you to think about like a global corporation.
Could you give me an example of one?
Um,
Ben and Jerry's?
Exxon.
Actually,
Exxon too, so.
What? Do you have a better, I'm just like,
Well, there are foreign oil companies besides Exxon,
yeah, I was just,
like
Yeah.
British Petroleum.
yes, British Petroleum.
Unilever.
Unilever, also another good, yeah, but not Ben and Jerry's.
Unilever.
Ben and Jerry's is Unilever.
Yes.
Yeah.
So if more of the value of that stock in Unilever, for example, is held by US shareholders, then they have to include that as passive income.
And I'll just add, it's, when you think about shareholders, I think people usually think about like a personal, like IRA or bank or a brokerage account or something like that. The taxpayers here, the stockholders can also be businesses, you know, LLCs, C corps, S corps, all those kinds of different incorporation levels. So when we're talking about owning 50% of a foreign controlled corporation, you could also be thinking about that as it could be a joint venture between two corporations. It could be just a subsidiary that's not wholly owned by the parent company. So it's not necessarily just investing in one sugaring operation in Quebec. And I will also just reiterate, this is specific to the CFC's passive income. So that's going to include things like interest, rents, royalties, those kinds of income. So it's specifically about passive income. And there's certainly all different kinds of ownership structures and entities that can be involved in owning one of these CFCs.
And I'm sorry, and you could own one of these CFCs through your 401k, would that be correct?
Whatever company's administering the 401k, and if that's a product that they have access to, I guess in theory, possibly.
You're more saying that companies are.
We would more usually expect this to be corporations and businesses, yeah. Correct. Okay. So charitable deductions for corporations, this is probably one of the simplest changes that was done in HR one. Previously, corporations could deduct charitable contributions equal to up to 10% of their taxable income. What this is saying is you can, this is instituting a floor. So you have to, the cap is not inclusive of the first 1%, but you still have to donate that amount to get this deduction. So, but you can only then deduct between 1 and 10%. So it's, instead of being able to deduct up to 10%, it's 9% with a floor. So it's just, it's, you have to get above the floor before you can deduct anything. Again, because Vermont coupled to this provision, linking up would cause it to flow through to the state. Okay, so I believe this is the last one. There's the expanded exclusion on gains from qualified small business stock. HR 1 allows stock for corporations issued after July 5th of 2025 with aggregate gross assets of below 75 million to qualify as a qualified small business stock. So this is an increase from the previous threshold of 50 million in aggregate gross assets or below. And another change that they're making here is that they're saying that investors who buy these shares can exclude 50% of the capital gains if they hold them for at least 3 years, 75% at 4 years, and 100% if held for 5 years. HR1 also increased the first share exclusion cap from 10 million to 15 million. And again, because Vermont is coupled to this provision, linking up would allow the expanded aggregate gross assets threshold to increase, and also the changes to the holding period requirements. I think previously it did not have the step-up basis. So it just had after 5 years, you can exempt or exclude those capital gains. Oh, and then I just have a quick slide. This is not corporate, but it's something that's in the bill that's flowing through. It's the federal changes to child and dependent care credit. Really what this is doing is it's just increasing the percentage of expenses on dependent care, child and dependent care, from 35 to 50% and expanding the phase down. This is one credit that never phases out, it phases down. And so Vermont, sort of our nexus with this credit is that Vermont has a similar credit. We use all the federal definitions and treatments, but we say, okay, you got the federal credit, they did all the math and calculations for it. You can get 72% of that on your state income taxes. So from the previous slide, you saw that this is $1 million starting in fiscal year 27. Just to remind you what the existing value is. This is usually about $4.8 million in foregone revenue. So the additional million would be bringing it up to about 5.8. And this is just to sort of illustrate what the changes in the reimbursement rates look like. This is previous law. You can see that at the very low incomes up to 15,000, you can claim 50% of those expenses. But that decreases until about 47,000, where it's at a rate of 35%.
That's orange.
Let's see. So orange is for unmarried,
Oh, okay.
and
Oh, I'm
then
sorry, it says it right at the
yeah,
bottom.
blue is for married. Previously, they didn't make a distinction. So that's a reminder, refresh of all the things, if you link up, they're going to flow through.
Is it married and unmarried rather than single and file? It's like your actual marriage status?
That's how it's written.
I missed that the other 12 times we've talked about this. Thank you.
It's kind of breathtaking.
Thank you.
So Kirby's going to share all this language. So I'm just going to list provisions that are in the language and then show you how that changes compared to the first table we looked at. So the language is going to show linking up to the child dependent care credit expansion, the amended limitation on business interest deduction, the more generous expensing of depreciable assets, for RADA share rules, the charitable deductions, and then there are also some other miscellaneous business and corporate provisions that are in there that are smaller. The language is going to propose decoupling, so decoupling entirely, not decoupling from HR1 treatment. The deduction for research and experimental expenses, the special, sorry. The qualified production property special depreciation, the QSBS exclusion, and then section 250 deduction, which is the foreign income provisions that we talked about. Additionally, it has language that increases the annual cap on the downtown and village center tax credits that can be awarded in a given year by 2 million, bringing it from 3 million up to 5 million. And it also includes language that increases the research and development credit from 27% to 75% of the federal credit allowed for R&D expenditures within the state of Vermont. So that credit is only specific to R&D activity that occurs within Vermont.
So there's an existing piece of state law, but it's set at 27%. And it's essentially saying we're going to decouple from this federal thing that might not be Vermont businesses, and we're going to use those resources to put towards a Vermont business specific credit. Do you want to go to the next slide that we can sit with while you like take some more water and cough? Because it seems.
I feel like this was very fast. I mean,
Yep, we're gonna,
it's really fast.
Yeah.
I was intentionally brief on this section because Kirby's going to do the full walkthrough of the language.
so we're just leave that up there and you do what you need to do with your body. We're not going to vote on this today. We're going to finish hearing from Pat. This is all very new news for everyone. It's new news for the tax department. It's new news for the whole administration. It's new news for Pat. It's new for me. It's new for all of us. We're going to work through it. And then after we hear from Pat, we're going to take a break. Then we're going to look at Kirby's language so our brains can digest into the ether. And then we'll all get to sleep. And then Pax will maybe could try to come in on Friday. And then we have the whole week next week to just think deep thoughts by ourselves. Which I'm so excited about. Yes, Representative Maslin.
Definitely need to study before the quiz.
Yes, yep, and that's why I'm.
Can we ask questions about some of the language? Just,
Thank you.
can I ask a question about the child tax credit?
Yeah, it's, yes, and are you all done with your body?
Start.
We'll get to it.
Go ahead.
I'm just wondering, an example. Two people are married. One parent is killed in a terrible accident. The remaining parent has 2 children. They're no longer married because there's only one parent. And this is going to phase out that tax credit faster. I guess my question is, in terms of coupling or decoupling, can we also modify who benefits from these credits at the state level? That's okay.
You would have to set up a independent Vermont CDCC. But technically you could, it would be it would require a lot more administrative work from the tax department to do, but.
Fair enough. Can I ask you a second?
Yeah, of course.
And I guess the other question I have about this is when you look at the impact of H1, just generally, I mean, the tax cuts for working Vermonters are trivial. The tax cuts at the top are really quite significant. And when we look at some of these credits, typically historically we've taken a universal approach, but what we're seeing is just, really quite significant escalation of wealth and growing cost at the bottom. And I just in going back to the fact that we don't know where all of these things are gonna hit on the cliffs. And I really am I'm just registering my concern that I'm very worried about the impact on working Vermonters, especially coupled with some of the things in here as well.
Yeah, absolutely. Representative Odie, we will have time to think about this. It's just the first, we don't need to all understand it right this moment. Yes. No one's asked to make a decision. Representative, did you have your hand? Or did
I
miss
had
that?
my question for this was, this is versus current law, this chart, so this is the change versus current law, not the change versus what we should have done.
So just as the first table represented active decision, technically an active decision you all would be making, each one of these pieces here represent an active decision in our sort of net revenue change relative to the consensus forecast.
Ask another question. I'm not a specialist in tax law, but this qualified small business stock gain exclusion feels a lot like the new Roth to me. And do we know if the rules have, I mean, there's a finite universe of people who take advantage of that.
We can hear more from Kirby about that, and I came forward, there was a really great study from the Treasury
Treasury or Fed, I forget which one of those two.
last spring that I'll send you. It's really interesting because frankly, like no one, from my quick read of it, no one had any, and we took a little bit of testimony about this, maybe from the ITEP folks. But no one really had any idea, this has been in law for a little bit, and no one had any idea that it really cost any money. And then all of a sudden it was like,
This one's gonna blow.
Yeah.
Because there's a finite number of people who can participate. They also get to determine the value of that stock. And
I'll forward you the article.
this feels like the new Roth. Right.
In Roth IRA.
Yeah, but if you can set your stock at 0.001 and put it in, and then you're tax free for the rest, and it becomes Google, you're completely untaxed on anything you earn.
So we can ask Kirby more questions about how it's structured. Yes.
This might be a Kirby question.
Okay, so, I mean,
That's,
whatever you
if
want
it's a Kirby question, just tell me to wait, which is fine. On the, increasing the state R and D credit from 27 to 75, is that just R and D that happens in Vermont regardless of where the company is based, or is it a Vermont-based company doing R&D?
It's for R&D activity within the state of Vermont.
Regardless of, okay, yeah, just.
And you'll see that in the language that Kirby has as well.
And there's this, who, I do not know who was in this room when the R&D credit passed for the first time. But interestingly, they put in statute that the tax department needs to publicize every single company that takes this credit. And so you can look at everyone who took the credit when it was at 25.
That is interesting.
It's very interesting.
Could you go over what 250 is?
Were you here
again?
though?
250
You must have.
section?
That's the foreign income.
That's the foreign
That's
income.
the foreign income provisions, yeah.
That was a much smaller number before as well.
So this is a little different. So the first table shows you a slight increase of, I think it said about $2 million for linking up.
Yeah.
What the language Kirby will show you is proposing is to decouple from the deduction available for this type of income entirely. So it's a little different. So that's where the larger revenue increase comes from.
Okay.
Yeah.
Are you confident in that number?
I feel much better about that number. There was a lot of sifting through forms, and we actually do have some better data available to get to this compared to some of the other provisions.
I don't know that this influences our decision, but has there been any good modeling people have seen? I mean, and some of these things are taking place the day before inauguration day and ending right before inauguration day in 2028. Is anyone looking at the broader economic impact of juicing things this way?
I think any of the national partners are, and we've sort of looked at that, like Pew has done studies on it. I've seen stuff from Center for Budget and Policy. I think the is it the Taxpayers Federation? What are they called? I don't,
Yeah.
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 I guess what I'm trying to back into is whether or not something is good policy is one question, but I have serious concerns with naked politicization of policy because it affects us long term.
But yeah, like any of your reputable sources on economic, any. And probably some whatever the other word is. Basically, anyone who talks about economics has done exactly what you're describing, and there's an article for you from whatever source you want.
I know.
Okay.
It's
Um,
just kind of strange that it's so naked.
yes, it is. Do you have, is this your final slide?
It's not.
Well played.
Okay, I don't see any more questions for Pat. So one of our witnesses in our 10:45 slot has canceled, and so what we're gonna do is take a 15-minute break now and then come back and get Kirby. And so let's be back here at 10:20. And then we'll have like almost an hour with Kirby.
Thank you. Unbelievable. Your team.
You know, I got some evidence for the pictures.
And he can add